Okay, let's unpack this. A stock price that's cratered by over 99% since its IPO.
Wow.
Yeah. That's the jaw-dropping story of LifeWord Ltd, ticker LFWD. You probably knew them as ReWalk Robotics before.
Right, ReWalk. So how does a company with, what seems like revolutionary technology end up in such a dramatic decline? It's kind of a puzzle.
It really is a
Yeah,
paradox, like you said. Innovation on one hand, but this stark financial reality on the other.
exactly. So today we're doing a deep dive. We've got this research analysis dated April 27th, 2025, and we're going to try and understand what's actually happening with LifeWord. They're a microcap playing in that rehabilitation tech space.
Yeah, our goal here is pretty simple. Cut through the noise, use our sources, and give you a clear picture.
We want to dissect LifeWord, really get into the nuts and bolts, understand the business, the challenges they're up against, and maybe what the future could hold.
We've looked at a bunch of stuff to pull out the key info for you.
And to make it easier to follow, we're splitting this into two halves. First up, we'll focus on the core business. What do they actually sell? Who's running the show? And what's the financial health look like?
Makes sense. Then in the second half, we'll switch gears. Look at how the market sees LifeWord, who owns the stock. That's always interesting, and the big risks.
Yeah, and we'll specifically dig into one risk flagged in the research, potential U.S. tariffs hitting in 2025. That could be a big deal.
Definitely. And we'll wrap it all up with a value investing angle on the whole thing. Sound good?
Let's do it. Where do we start? The basics.
Yeah, let's lay the groundwork. Chapter 1, Business Understanding. So, LifeWord, they've actually been around since 2001, founded over in Israel.
Right.
They only rebranded to LifeWord in September 2024, so pretty recently. Seems like they wanted a name that reflected a broader focus than just the original ReWalk exoskeletons.
Okay, makes sense. Still based in Israel.
Headquarters, yeah. But they've got operations in the U.S. and Germany, too. Went public back in 2014 with that IPO.
And it's not a huge company,
Yeah.
employee-wise.
No, pretty small team. Around 80 people, according to the analysis.
Yeah.
Their mission statement is pretty ambitious, though.
Yeah.
Deliver life-changing solutions for mobility, rehab, and wellness.
Okay, so what are those solutions? What's in the product portfolio now? It's more than just the ReWalk, you said.
Oh, yeah, much more now. The ReWalk exoskeleton systems are still core, of course. There's the personal version for home and community use, targeting paraplegia from spinal cord injuries. And there's a rehabilitation version for clinics. And they're still innovating. They're launched the new ReWalk 7 Personal in the U.S. just this month, April 2025, after getting FDA clearance in March.
So that core tech is still evolving. Good sign. What else?
Well, the big move was acquiring AlterG anti-gravity systems back in August 2023.
Ah, the anti-gravity treadmills. I've heard about those. NASA tech, right.
Exactly. Differential air pressure. Lets you precisely unload body weight. Super useful for all kinds of rehab, even athletic training. The research really highlights this as a key differentiator for them now.
Okay, that broadens their reach considerably. Anything else?
Yep. They've got the Restore Exosuit. It's different, soft, textile-based, designed to help stroke patients with lower limb rehab, improving their gait.
Interesting. Soft robotics.
And finally, the MyoCycle FES systems. That's functional electrical stimulation cycling. Good for folks with muscle weakness or paralysis. They just expanded a partnership with Mayo Land in March 2025 to boost referral sales for home use systems.
So yeah, a much wider range of products now. Exoskeletons, anti-gravity treadmills, soft suits, FES cycling. Definitely move beyond just that initial ReWalk focus.
Absolutely. Now, how do they sell all this stuff? It's a mix. Direct sales force and also third-party distributors. They target hospitals, clinics, rehab centers, but also individuals.
And they're shifting strategy there a bit.
Seems like it. Moving more towards direct sales in key markets like Germany for AlterG and the U.S. for the new ReWalk 7. Probably aiming for better margins.
Makes sense, but direct sales cost more upfront too.
True. They're also using partnerships, like with Mellon we mentioned, and another one with Core Life to help get ReWalk covered under workers' comp.
Okay, so strategy is evolving. How did that translate financially, say, last year?
Well, FY 2024 revenue was actually a record for them, $25.7 million. That's an 85% jump from the year before.
85%. That's huge. What drove that?
Mostly the AlterG acquisition kicking in, plus some initial sales from Medicare starting to cover the ReWalk system.
Ah, okay. So acquisition plus reimbursement finally starting to pay off on the top line.
Looks like it. Just to give you an idea, in Q4 of 2024, AlterG brought in $5.5 million, of their $7.5 million total revenue for the quarter.
Wow, so Altergy is already a huge chunk of the business.
Yeah, so the core value proposition is pretty clear, right? Innovative tech, real functional benefits, improving quality of life. Sounds great on paper.
It does sound compelling. And that strategic shift to a multi-product company makes sense, widens their addressable market way beyond just spinal cord injury.
But the analysis does point out adding all these different products means more complexity, managing different sales teams, customer types, supply chains. It gets complicated.
And that move to direct sales. Higher potential margins, sure, but it also means higher fixed costs, more financial risk if sales don't meet expectations. It's a gamble.
Definitely a strategic bet. Okay, so that's the business landscape. Now, let's pivot to Chapter 2, management evaluation. This is where things get interesting.
Right. How good is the leadership? Are they aligned with shareholders? Always crucial questions.
The analysis spends a fair bit of time on the outgoing CEO, Larry Jasinski. He was there for 13 years. Long time.
13 years, okay. And during that time?
Well, there were definitely achievements. Tech advancements, getting FDA approvals for ReWalk, taking the company public, landing that Medicare reimbursement finally, buying Altergy, the rebranding. Those are big wins.
Okay, sounds positive on the operational and regulatory front.
And it's a massive but. Over that same time, shareholder value just got decimated, down roughly 99%, and the company's basically never been profitable.
Ouch, 99% down while achieving those milestones. That's
Sure.
stark.
It is. He announced his retirement in February 2025, stepping down this quarter, Q2. The CFO is Michael Lawless. There are other execs, and some recent board changes, too.
So a CEO transition is underway right now. That's always a critical point for a company.
For sure. The board's got a search committee looking for a replacement. They even postponed an investor event recently, which kind of highlights how important this is.
And how has management reacted to the financial struggles?
We've seen some typical moves for a company under pressure. Reverse stock splits, which, often happen when the price gets really low.
Not usually a great sign.
Nope. A restructuring plan aimed at saving $3 million a year in costs. And they just did a $5 million direct offering, basically selling more shares to raise cash.
Okay, so actions pointing towards financial pressure. What about communication? Are they transparent?
Seems reasonably standard. Regular press releases, SEC filings, they have an investor relations website. They did give an outlook for FY 2025. And ethically, the analysis didn't flag any major red flags.
All right. But the big one, shareholder alignment. How does that stack up?
It's really mixed, isn't it? On the plus side, getting reimbursement wins helps shareholders, opens up markets.
Sure.
But then you have the massive value destruction, repeatedly issuing shares and warrants, which dilutes everyone else, those reverse splits. And then there's executive compensation.
How high was it?
$2.3 million for the key execs in 2023. Which, seems pretty high when compared to the company's performance and the shareholder returns, or lack thereof.
Yeah, that can definitely rub investors the wrong way. Any insider trading activity.
Net selling. More shares sold by insiders than bought over the last year or so.
Yeah.
That can be interpreted sometimes as insiders lacking confidence.
So it's that paradox again. Innovation and regulatory wins under the outgoing CEO, but just terrible financial results and shareholder value destruction.
Exactly. It really puts a spotlight on the financial balancing act they've been trying, and maybe failing, to pull off. Suggests a big strategic rethink might be needed.
Which leads us straight into capital allocation. How well have they actually used the money they've had? Chapter 2 continues.
Right. Have they invested wisely? Well, they've definitely put money into R&D. The new ReWalk 7 shows that. But their operating expenses are really high. About $33.4 million in FY24, and that included some big one-off charges compared to only $25.7 million in revenue.
Oof. Expenses way higher than revenue. Not sustainable.
Yeah.
What do analysts think R&D spending is, roughly?
Estimates are like $4 million to $9 million a year, so significant investment there.
And what about M&A, mostly that Altergy deal?
Yeah, primarily Altergy in August 2023, like we said, huge revenue boost. But the impact on the bottom line, on profitability, still unclear, according to the analysis. They've tried partnerships, too, like with Mao Wine now. Yeah. And they had a plan for a China JV that seems to have fizzled out.
Okay. Have they ever bought back shares to show confidence or return value?
No history of share buybacks at all. It's been the opposite, issuing more shares. That recent $5 million offering, plus they filed a form, an S1, that suggests they might sell even more shares down the road.
So dilution has been the pattern.
Yeah.
And dividends.
Never paid one. Given the consistent losses, that's not surprising, and it's highly unlikely to change soon.
Which brings us to the bottom line metric here. Return on invested capital. ROIC.
Yeah, and the analysis says it's significantly negative.
What basically means?
Means they're destroying value. They aren't generating a positive return on the capital investors have put into the business. You've got negative operating profit after tax NOPAT because of the losses divided by the invested capital. It's a recipe for value destruction.
So the conclusion on capital allocation is pretty harsh then.
Seems unavoidable. Management just hasn't used capital effectively to actually grow shareholder value. AlterG helped the top line, but didn't fix the core profitability problem. And relying on selling more shares isn't a viable long-term plan.
Okay. A tough assessment of management's financial stewardship. Let's dive deeper into the numbers themselves. Chapter 3, Financial Health.
Right. We've touched on bits, but let's consolidate. Market cap is tiny, around $15.4 million. Share price, 1.45 near the lows. And yeah, that 99% drop since IPO just hangs over everything.
And don't forget that 1-for-7 reverse split in March 2024, another sign of distress.
Exactly. Valuation ratios. PE is meaningless with negative earnings. Price to sales around 0.51. Price to book is 0.85.
That PB below 1 might look cheap to some,
but probably isn't. Given the context, it likely just reflects the market's serious concerns about their financial viability, not some hidden bargain.
Right, context is everything. What about that revenue growth picture again?
That's the one relative bright spot, as we said. Record FY24 at $25.7 million, up 85%. Guidance for FY25 is $28.30 million, so 9-17% growth.
And analysts are even more optimistic.
Yeah, consensus is higher, maybe $31-37 million this year, and then they project a really big jump in 2026, potentially $57-60 million. Big numbers, but projections are projections.
Okay, but how about profitability, margins?
Gross margin in FY24 was about 30.8% over GAAP. It got better in Q4 on an adjusted basis, 45.4%. And they're guiding for adjusted gross margin to improve further in FY25, maybe 47-49%.
So some improvement at the gross level, but operating in net margin.
Still deep in the red. Net loss for FY24 was around $28.9 million, and they expect to keep losing money through 2025.
$29 million loss on $26 million revenue. Yikes. What's the balance sheet look like? Debt. Cash.
They report having no debt, but you always need to check lease obligations. Those can act like debt. Cash is the big worry. Only $6.7 million left at the end of 2024.
$6.7 million. And free cash flow.
Consistently negative. Burned through about $22 million in cash from operations in FY24.
Okay, so that stark difference, strong revenue growth, but terrible, persistent losses and cash burn. That's the core problem, isn't it?
Absolutely. It signals fundamental issues. That low PB isn't a bargain signal. It's likely a distress signal.
So assessing overall financial stability, it sounds pretty unstable.
Yeah. Consistent net losses every single year from 2015 to 2024. Continued losses expected this year, may possibly profit in 2026, according to some forecasts, but that's a long way off and uncertain.
No dividend ever. Stable at zero. That no debt might just mean they can't borrow money.
Could be. Which forces them into those dilutive share offerings. Working capital management isn't helping either, often using cash.
And that cash position, $6.7 million at year end. What was the burn rate in Q4?
About $4 million operational cash burn just in Q4 24.
So $4 million burn per quarter, $6.7 million cash, even with the recent $5 million raise.
The runway's really short. They'll likely need more cash, probably through selling more shares pretty soon. There's a significant going concern risk here. The risk they might not have enough money to keep operating.
Okay, so the first half paints this picture. Really interesting, needed technology, some market traction, especially with AlterG boosting revenue. But underneath, serious financial bleeding, questionable capital allocation, and a management team facing a massive turnaround challenge under a new leader.
Exactly. So how does the market react to all this? What are the vibes out there? And what other hurdles are on the horizon? That's what we'll get into in the second half.
Right. We need to look at market sentiment, ownership, risks. Let's take a quick break and then dive into that.
All right, welcome back. We're diving back into Lifeward Ltd. We've covered the business, the management, the shaky financials. Now for the second half, starting with Chapter 4, Market Sentiment. And like we teased, it's a bit of a split decision here.
It really is. You've got this overwhelmingly negative perception baked into the stock price. I mean, down over 99% since IPO, trading near its 52-week low. That speaks volumes.
Yeah, and you mentioned high short interest.
Definitely. A significant number of investors are actively betting against the stock. The trading volume is usually low, making it a microcap, though it can spike on news. It just screams struggling company to the market.
But then the analysts, what's their take?
It's almost like night and day. The few analysts covering it are mostly saying buy or strong buy, and their price targets way, way higher than the current $1.45. Average targets are like $8.50 to $9.50. One even goes up to $13.
Wow, that's optimistic.
Yeah.
How do we square that circle? Market hates it, analysts love it.
Well, that massive gap is the red flag for value investors. You have to be skeptical of those analyst targets. Maybe they're focused too much on the potential of the tech and not enough on the reality of the finances we just discussed.
And you have to consider potential biases, right?
For sure. Limited analyst coverage means the consensus isn't very robust. And the fact that one of the banks issuing a buy rating also helped LifeWard sell shares in that recent offering. Well, you have to question the independence there.
Right. So take those analyst ratings with a big grain of salt. Has any recent news actually moved the needle?
There's been good news. FDA clearance for ReWalk 7, the U.S. launch, those partnerships with CoreLife and Mailline, some reimbursement wins in Germany and Hungary.
And did the stock react?
Sometimes you see a brief pop, but the gains just don't seem to stick. The overall negative trend tends to win out.
Because the good news is balanced by bad news.
Or mixed news, yeah. The CEO retiring, that dilutive $5 million offering, postponing the investor day, missing earnings estimates. It counteracts the positive developments.
And that short interest you mentioned, how high is it?
As of late March 2025, it was over 760,000 shares short. That's about 8% of the float, which is pretty significant. And the cost to borrow those shares to short them is really high, like 45, 60% or more. Whoa, that means shorters are paying a lot, suggesting strong conviction that the price will fall.
Exactly. There's also high off-exchange short volume. People are betting against it in multiple ways. We even saw some put option activity in institutional filings. And there was a weird spike in fails to deliver shares around mid-March, coinciding with news and the reverse split. Could suggest some market plumbing issues or unusual activity.
So the market action, the short interest, it all points towards heavy bearish sentiment, directly contradicting those few bullish analysts. The market seems way more worried about the immediate financial risks.
Okay, makes sense.
Yeah.
So who does own the stock then? Let's move to Chapter 5, ownership structure.
This is another really telling piece of the puzzle. Institutional ownership, meaning big funds, pension funds, asset managers, is exceptionally low, like only 2 to 5% of the company.
2 to 5%. That's tiny.
It's incredibly low, spread across maybe 24, 30 institutions, mostly holding very small positions. It signals a real lack of interest or confidence from professional investors.
Who are these institutions then? Any recognizable names?
Mostly quant funds, brokers, advisors with tiny allocations. One fund that held a bit more, Kent Lake Capital, seems to have cut back or sold out completely recently.
And the trend. Are institutions buying or selling overall?
Net selling in the recent quarter. Some funds reduced significantly or exited entirely. New positions being taken are generally very small.
What about insiders?
Yeah.
Management, directors?
Overall, insider ownership seems pretty low, too. And
Yep.
looking at trades over the past year, it's been net selling there as well. More shares sold than bought in these significant trades.
Yeah, there were some large sales by a fund called Lynn Global Fund to OTLP back in January 2025. That outweighed some smaller director buys that happened late last year. Ownership looks very spread out, no single controlling shareholder.
And what does that low institutional ownership mean for governance?
Potentially less pressure on management from big, engaged shareholders. Plus, as a foreign private issuer, they have different, sometimes looser governance rules than U.S. companies. It just adds to the picture of a company flying under the radar of major investors.
Okay, so low institutional confidence, net selling. Not a great ownership picture. Let's move to Chapter 6, risk assessment. Can we quickly run through a SWOT analysis based on the research? Strengths, weaknesses, opportunities, threats.
Sure. Strengths.
Yeah.
Innovative products, regulatory approvals, those reimbursement wins are key. They have a global footprint and showed recent revenue growth.
Okay, weaknesses. Sounds like there might be a few.
Yeah, big ones. Consistent losses, that negative ROIC showing value destruction, the weak cash position and high burn rate, small company size, high operating costs, the terrible history of shareholder value loss, low institutional ownership, net insider selling. It's a long list.
Definitely weighs things down. What about opportunities? Where's the potential upside?
Well, the rehab tech market is growing. More reimbursement coverage would be huge for them. Getting synergies from Ultragy and partnerships, maybe a turnaround under the new CEO, and continued product innovation.
So there is potential if they can execute, but what are the threats?
Competition is fierce. The biggest threat is just financial viability. Can they survive long enough to get profitable? Risk of missing targets, needing more dilutive financing, regulatory or reimbursement changes going against them. The CEO transition itself carries risk, tech becoming obsolete, and broader economic factors.
And the research specifically called out U.S. tariffs in 2025?
Yes, as a specific near-term threat. Their supply chain is likely global, possibly sourcing from places like China that could be hit by tariffs.
How would that impact them?
Increased costs, basically, squeezing already thin or non-existent margins. They probably can't easily pass those costs on in the healthcare market, could disrupt their supply chain, maybe slow down R&D if they have to find new suppliers. For a company this financially fragile, new tariffs could be a really significant blow.
Okay, a lot of risks to consider there. So, wrapping it all up, Chapter 7. Brief conclusion. What's the final verdict from a value investing perspective?
It looks pretty challenging, honestly. Going back to that initial hook, the 99% stock drop. The analysis suggests why. The business itself, rehab tech, is understandable. But their competitive edge, their moat, seems weak.
And management's track record?
Questionable, at least in terms of creating shareholder value. Decades of losses and value destruction speak volumes. And the current valuation, even though the stock price is low, doesn't seem to offer that margin of safety investors look for. It smells like a potential value trap.
Looks cheap, but might just keep getting cheaper or go nowhere.
Exactly. You've got this amazing, potentially life-changing technology. You've got markets with real needs, real growth potential, but the risks just seem overwhelming right now.
Financial viability risk, execution risk, competition, external factors like tariffs.
Yeah, it's a heavy burden. So while the whole field of rehab tech is exciting, LifeWard specifically, based on this analysis as of late April 2025, faces some really significant hurdles to creating long-term value.
It's a tough case.
It really is. So after digging through all of this, the innovation, the struggles, the potential, the risks, we want to leave you, the listener, with a question to chew on. Given LifeWard's undeniably cool technology and the clear need for products like theirs, what single factor do you think is the absolute most critical for any potential turnaround? Is it getting that new CEO in place? Is it a radical shift in financial strategy to stop the bleeding? Is it finally getting widespread reimbursement? Or is it something else entirely we haven't focused on?
Interesting question. Something for people to ponder. And if you want more deep dives like this, definitely subscribe to the Stock Analytics AI YouTube channel.
Yeah, please do. We'll put links to the research we talked about today in the description below.
And of course, the standard disclaimer. This was all based on information available as of April 27th, 2025, and the specific research analysis we used, it's absolutely not financial advice.
Nope. Do your own homework, talk to a financial professional before making any investment decisions. And just so you know, AI was used in preparing the analysis we discussed today.
Well, that was quite the journey through ReWalk Ltd. Thanks for tuning in.
Yeah, thanks for joining us on this deep dive. Hope you found it useful.